everyone, I am Imee Ruaza of Davao Central College and I'll be teaching great things just all about mathematics. Today, our topic is about
the market index and the theory of efficient markets.
but before we begin, let us identify first our objectives.
At the end of this video, you will be able to distinguish market index and understand the concept of the theory of efficient markets. Let us start.
The tool used by market investors and commercial managers in describing the stock market is what we call the market index. It is also the quantity used in comparing the return on a specific investment.
Market index is the weighted average value of a group of a specific investment tool. This value is computed by combining several selected stocks or other investment tools and expressing their aggregate value against a base value at a specific time. However, this quantity is designed to represent the entire section of the market and thus track the market section's changes over a certain period of time. This value is used by investors as benchmark in comparing their own company's performance. This value also provides them a ready overview of market trends. For example, if an index goes up one level or 1%, this means a group of stocks has correspondingly increased its value by one level as well, thus becoming more attractive to investors. What are the importance of market index? Although the stock market is much more dynamic than the indices suggest, along with the fact that there are different ways to calculate the indices, causing calculation bias, the stock market indices are useful in a number of ways to stock investors. First, the market indices provide an historical perspective of stock market performance, giving investors more insight into their investment decisions. Investors who do not know which individual stocks to invest in can use indexing as a method of choosing their stock investments. The second benefit of stock market indexes is that they provide a yardstick with which investors can compare the performance of their individual stock portfolios. Individual investors with professionally managed portfolios can use the indexes to determine how well their managers are doing in managing their money. The third major use of stock market index is as a forecasting tool. Studying the historical performance of the stock market indices, you can forecast trends in the market. The internet bubble is a prime example, which in hindsight provides 20 over 20 vision. In addition, a stock index is used to reflect the hypothetical portfolio of stock market and help investors track the overall performance of a group of stock over time. It also describes the performance of the stock market or a specific portion of it and to compare returns of investments. Generally, an index uses a weighted average of stock prices, so larger companies count more in the calculation. On the contrary, a bound index or bound market index is used to compare treasury bills or corporate bonds. It is a method of measuring the value of a section of the bond market. It is computed from the prices of a selected bonds, typically a weighted average. It is a tool used by investors and financial managers to describe the market and to compare the return on specific investments.
Now, let's move on to our next topic. Efficient market is a belief that in an ideal efficient market, all participant investors are aware of all available relevant market information at any time and have used the stock knowledge they have, including predictions of market trends in trading stocks, bonds, and other securities.
Stocks trade their fair value all the time. As such, it would be impossible for any investor to beat the overall market performance, either by expert selection or market timing. Do you know why? The theory of efficient market is an investment theory that states that it is impossible to beat the market because stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. Thus, the only way possible for an investor to earn higher returns is to agree on investment that entails higher risk.
So that's all for this discussion. I hope you learned a lot and please don't forget to hit the thumbs up button. Thank you for watching.